How's it going? I'm Tyler Freed with Windermere Real Estate, and today we're going to talk about some questions that clients ask me in regards to financing. So I brought the expert here, Ryan Leopold from Cobalt Mortgage. Ryan, how you doing?
I'm doing great. Thanks for having me. I appreciate it.
Yeah, good to have you here. Thanks for taking time to do this today. So let's just start off. The first question people always ask about is, how much money do I need for a down payment? What do you tell them?
Yeah, it's a good question. I usually look at it from the standpoint of not necessarily from a money standpoint, but from a percentage standpoint. So low down or zero down programs are harder to come by these days. So you're looking at, you can do zero down if you do like a VA loan, if you qualify. FHA is usually about 3.5% down of the purchase price. And then if you can, 5% down is always the better way to go from terms and conditions standpoint. So that's the down payment part. And then when it comes to cash to close, you have the down payment and you're always going to have closing costs, which could be anywhere between $2,500 and $2,700. And then prepaids are going to be prepaid taxes and insurance, which is all monies that you have to bring to close. And the biggest thing is when you put a plan together on the mortgage side is really figure out how much they have and how much they can use will really dictate how much house they can buy from a down payment standpoint.
Awesome. And then sometimes we're able to get the sellers to contribute towards that, which is really huge too.
Absolutely, and that comes a part of that plan with a lender, a buyer, and the real estate agent all being on the same page to service the client and really create a plan that's going to work for them.
Awesome. And then we've kind of run into this lately. Some people don't have credit or they've got bad credit. What do you recommend when you see that? I mean, how do you approach that challenge there?
Yeah, so there's two different ways. So a lot of times your credit score is going to impact the programs that are available and the interest rates available. So I always tell people anything kind of over 700 is pretty good. Anything over 720 is really good. Anything over 740 is considered excellent in the eyes of a lender. So if you're in that range, it just opens up more options and better interest rates. If you do have lower than 700 in the 600 credit score range, there's still programs available, like FHA is very liberal when it comes to credit scoring, and so is VA. And if they're just kind of not in that range, they need a little help, we can certainly set them up with credit repair companies that can maybe help some of the blemishes they have, help get their credit score up in 1 to 3 months, so they can be in a position to get the best terms and conditions possible for a house.
So that's pretty quick, 1 to 3 months. It's really good to hear that you guys have those options and everything. Are a lot of people taking advantage of that when they're getting their credit repaired? Absolutely,
and again, it just comes down to having that initial consultation, having a lender review a credit report and see what issues do come up that are affecting that credit score, and then working on a plan to help them get there. And sometimes it's as easy as 1 month, sometimes it may be a little bit longer for deeper issues.
All right, awesome. Well, last question. In terms of the qualifying, people always ask, if I'm spending $1,600 a month on rent, what kind of home can I afford? How do you approach that with them?
Yeah, so it all comes down to what we call a debt-to-income ratio. So a good way to do it, and if you kind of want to work the numbers up on your own at home, is you take your gross household monthly income. Again, it's gross before any taxes or any 401k or anything's taken out, and then divide that number by 12. Okay. So if we have, for example, $5,000 a month in income, usually lenders will allow about 45% of your gross monthly income can go towards debt. So 45% of 5,000 is about $2,250. Then you take off your minimum payments that you have that would come up on a credit report. So that's a minimum payment on a car, credit cards, student loans, things of that nature. So whatever's left over, that is how much that can go towards a mortgage payment, which is going to include principal and interest on the loan, taxes, insurance, mortgage insurance if applicable, or homeowners association dues. So what I always tell buyers is understand what you can be qualified for, and let's find a level of where you feel comfortable.
Perfect. And then that payment's all wrapped into one, right?
It's all into one, and yeah, so your payment will be principal and interest, tax, insurance, mortgage insurance, and you just make one payment every month, and it takes care of everything.
Awesome, Ryan. I appreciate it. Well, thank you for your insight today and letting us know how the process works. Really helpful.
Great, thank you. Appreciate having me.
All right, awesome.